What's different about taxes for 2018 is the Tax Act of 2017. Biggest change in tax law in 30 plus years. In the charitable contribution area, there's pluses and minuses. They actually raised the amount you can give to 60% of your income, up from 50. That's a big plus. The other issue that you need to keep in mind is they also raised the standard deduction from where it was at about $6,400 up to $12,000 for individuals, $24,000 for a married couple. What that means is everybody now gets $24,000 of deduction standard. They eliminated exemptions, which don't help a lot of people either, but they raised it up to $24,000. So if your contributions, taxes, and interest don't exceed $24,000, you take the standard deduction. If they're close to that, it makes sense to maybe increase your contributions this year as much as you can. Even consider giving all of 2019. It's called bunching. That's what the CPA and tax attorneys seem to be saying is the way out when people are really close. Bunching means let's put 2018 and 19 all in 2018. The plus for that is you do get over the threshold and you'll count it. The plus for the church is we've got the building fund going and it would help kickstart that. If you want to spread it out, you can actually put it in what's called a donor advised fund. Fidelity, Schwab, Christian Foundation of the West all have where you can put in all of next year's contributions before the end of December and then spread it out evenly over next year to the church and the other charities that you're supporting. Okay. Normally the best gifts that you can give the church and any nonprofit are what are called appreciated assets. If you bought Apple stock 12 years ago, it's gone up probably 10 times since then. Well, if you sell it and then give the church the cash, you've got to pay tax on that capital gain. Where if you give church and nonprofits your appreciated stock, you get the full deduction as if it was cash, and you don't have to pay tax on the capital gain. So any appreciated assets, stocks, bonds, part of a business, real estate, are great tools. Anything that has a huge gain and appreciation, by giving it direct to the church, you can avoid that taxable gain, which, by the way, in California, the capital gains rate is 35.8% in the highest brackets. It's not 15% like sometimes you hear about, so people need to be careful. If you happen to be at the ripe old age of 70 and a half or more, like I am, another wise thing to do is you can direct your investment firm to send the money directly to the church for your required minimum distribution. That's what RMD stands for. And once you reach 70 and a half, the IRS wants to get their pound of flesh out of you before you pass away, so they force you to take this. By giving it direct, you don't have to report the income. You don't get a deduction for it, but again, if you're in that standard deduction range, that helps a lot. If you've got medical bills, by lowering your adjusted gross income, you get more credit for that. So there's just good reasons to give that direct instead of take the money in. The business that I'm in, helping people establish what I call a capital gains bypass trust, which is really known as a charitable remainder trust, or for people that have appreciated real estate, again, stocks and bonds, they're selling their business. This tool is out there to allow a family to sell a hugely appreciated asset inside this trust, pay zero tax, and get retirement income off of it the rest of their life. And there's enough varieties out there to accomplish any family's financial planning need. The great thing about it is you can direct where the monies go when you pass away. You get income for it the rest of your life, but then you can, when it passes away, you can direct it. A good friend of mine, Ron Blue, says, do your giving while you're living, so you're knowing where it's going. Well, that's true currently, but you can also do that into the future. So these are great tools if people are selling, especially Orange County real estate. They bought it 20, 30 years ago. It's highly appreciated. This could be a great way, and you get a ginormous tax deduction now, probably 30-40% of the property. That tax savings gives you, again, the ability to give the church and your other charities much more income, because you can give them the tax income you just saved.